Welcome to the deep dive. Our mission today is to take a look at a stack of highly proprietary financial documents,
That's right. Specifically, the NFIB behavioral flow gradient analysis.
authored by Devin McClarty, who's the founder of Structural Intelligence, and published by D Publishing Group.
And owned by D Investment Enterprise LLC, it's all quite interconnected.
Our goal here is really to translate that complex structural theory, the core ideas, into something clear and usable for you.
Exactly, because this is a really remarkable set of sources. It shows exactly how a major institutional strategy,
D Investment Enterprises strategy.
right, how they validate their own proprietary models using, well, real-world data from Main Street, small businesses.
And our focus is dead center on McClarty's core thesis. It's a thing called the behavioral flow gradient.
Mm-hmm.
We're going to try and break down the firm's structural interpretation system, see how that small business data confirms it, and, well, ultimately understand the investment implications.
Right, because the market, according to this analysis, seems to be splitting into what they call two fundamentally different worlds.
And that split, that's the key, isn't it?
It's the absolute crux of the issue, yeah. The analysis confirms the market separating into systems defined by structural faith,
Yeah.
faith in the stability, the structure, and then firms defined by economic dependence.
Dependence on, like, credit and conditions.
Exactly. And these documents we're looking at, they provide the specific metrics, the behavioral proof needed to sort of navigate this widening structural divide.
Okay, let's unpack the structural pressure then. Where do we start?
Well, we have to begin with the scaffolding, right? The framework itself. This analysis, it's dated November 11th, 2025.
Okay.
And its main purpose is to provide, like, real economy confirmation for their proprietary system.
The Tri-Engine Integrity Computation Framework. That one.
That's the one. It's really the structural heart of how the firm views the market.
Okay, it sounds dense. We've got VFI, DDI, and TDI. Let's try not to get lost in the alphabet soup here.
Fair enough.
If this is the heart of the firm's thinking, what's the basic function of this tri-engine system? And what story are its current readings telling us, structurally?
Okay, so the function is basically integrity. It's measuring if market behavior actually aligns with structural stability. You know, does the market feel stable based on how capital is moving?
Right.
The tri-engine system processes signals across flow, faith in currency, and the overall theme or trend.
And the NFIB findings, the small business stuff.
That's the real-world proof. It shows that the system's readings are, well, correct, grounded in reality.
Okay, let's take the first one then, VFI.
VFI, yeah. Volatility flow integrity. Its current signal is neutral,
Neutral.
which in their categorization points toward the faith zone.
Okay, what does neutral mean in this context? Discipline.
Exactly. It means the volume and direction of capital flow is stable. It's not panicked, you know. People aren't fleeing wildly, but it is disciplined.
So if the VFI is neutral, indicating discipline, where is that disciplined capital actually going? Where is it concentrated?
And that's where the NFIB data comes in. It confirms the answer. Stability.
Oh.
Well, the small business data is showing profit pressure, right?
Ah.
And credit tightness.
Yeah.
That validates the VFI because it proves capital isn't flowing to those stressed areas. It's concentrating in stable assets.
Like large cap stocks,
Like-
companies with pricing power.
Exactly. Those, and crucially, T-bills, government debt, safety.
Good.
So the strategic meaning is pretty clear. Institutional liquidity preference is high. They're seeking safety and structure, not really expanding into riskier credit-dependent ventures right now.
So it sounds almost like institutional investors are looking at Main Street's pain, the observable struggles,
Yeah.
and using that as confirmation for their own defensive moves. Is that too cynical, or is that basically the structural thesis here?
I wouldn't call it cynical. In this framework, it's just structural reality, how the system works.
Okay.
Now let's look at the second engine, DDI, dinar divergence integrity.
DNR. That's
Oh,
unusual.
It is. And its signal is stable at a slight negative, mega 0.42%. This is maybe the most unique part of McClarty's work.
Why the DNR? Why use that as a proprietary metric for integrity? Most firms focus on the dollar, maybe the euro, gold.
Well, that's where the structural intelligence angle comes in, I think. The DDI isn't measuring standard liquidity like dollar liquidity.
Okay.
It's meant to represent a structural measure of, let's say, non-Western or deep institutional faith. Faith outside of the usual USD liquidity pressures.
So like a deeper stability anchor.
Kind of. An indicator of global systemic stability, belief in hard assets, maybe non-dollar systems of stability. The firm sees it as an essential secondary anchor of faith.
And it's stable.
It's stable, which confirms the macro foundation is holding, despite all this localized credit stress we see in the NFIB data.
Got it. So the belief in the global financial anchor, not just the dollar, it remains intact. And that supports their whole disciplined strategy, right?
Precisely.
The structural foundation is holding, even if some of the building blocks, the small firms, are clearly struggling.
You've got it. And finally, there's the TDI, thematic divergence integrity. This one's flagging GCS.
Global caution signal.
Right, GCS at 43. That puts it squarely in the caution category. This index tracks sort of overarching macro themes.
And what does a caution signal practically look like in the real world? What does that mean on the ground?
It means that while there isn't outright panic, remember, the DDI is stable. The environment is structurally unfavorable for broad risk-taking, for expansion.
Okay.
But what's really crucial here, and this ties back to the NFIB data again, is that those findings add significant behavioral weight to this caution reading.
Okay.
It tells McClarty and his team that the caution isn't just some technical chart reading. It's being confirmed by the actual behavior of small businesses.
Like cutting inventory.
Exactly. Cutting inventory, pulling back. It shows faith is concentrated. It's not widespread. It's specific.
Okay, this is where it gets really interesting for me.
Yeah.
Because you said all these tri-engine signals are best understood through the lens of this behavioral flow gradient. We've established the pressure, the signals. Now we need to see the shape of this market split. How does McClarty actually define this fundamental separation?
Right. He defines the gradient by looking at two opposing poles of market conviction. Think of it like two ends of a spectrum.
Okay.
On one side, you have faith and scale systems, sometimes called the faith zone.
What falls in there?
Think mega cap companies, big infrastructure providers, the large financial institutions, basically entities with inherent pricing power.
Right. They represent a belief in durable structure stability.
They can absorb shocks, pass costs along.
Exactly.
And the other pole.
That's the dependence in small firms. Or the dependent zone. This is your micro caps, your Main Street businesses.
The ones feeling the pressure in the NFIB data.
Precisely. They are reliant, almost entirely reliant on access to cheap, plentiful credit. They need it to manage cash flow, fund operations, sustain inventory. Their fate is directly tied to monetary conditions. Okay, two zones, faith and dependence. And the critical dynamic, the report says, is that the gradient shape is flattening. Explain that. What does a flattening gradient mean visually, beyond just a ramp analogy? Why is that so dangerous for the dependence zone?
Okay, visualize maybe two mountain peaks. You have the peak of faith, tall, stable, and then you have the valley of dependence, low, vulnerable.
Got it.
When the gradient is flattening, it means the distance between that peak and that valley is getting vastly wider. And the slope, the path connecting them, is getting shallower, much harder to climb.
So it's harder for a small firm to climb out of the valley.
Much harder. The structural effort required for a small firm to move from dependency towards stability becomes monumental. Almost impossible in some cases, according to this view. The gap widens.
The structural forces are actively pushing them further apart. So what are the primary observable forces driving this widening gap? What's causing the flattening?
The analysis highlights two main drivers. First, and this is maybe the most obvious one, tightening credit markets.
Makes sense.
When the cost of capital skyrockets, think about it. A mega cap might see their borrowing rate rise from, say, 4% to 5%. That's an increase, but it's manageable given their scale.
Right.
But a small local business, maybe relying on a revolving line of credit, their cost might jump from 8% to 12% or even more. That can immediately cripple their operational cash flow.
So that directly harms the credit-reliant small firms and widens that dependent zone.
Directly confirms it, yes.
Yeah.
And the second driver,
What's number two?
tightening labor markets.
Yeah.
Rising wages, higher labor costs. They disproportionately hurt the dependent zone.
Why? Disproportionately, everyone faces higher wages.
True, but it's about margins and scale. A Fortune 500 company can probably absorb a 5% wage hike across, tens of thousands of employees. They have scale, they have pricing power.
They can pass some of it on.
Right. But think about a small manufacturer with maybe 50 employees operating on a thin, say, 3% profit margin. That same wage hike isn't just an inconvenience, it could be an existential threat.
They don't have the buffer. The lack of margin prevents the small business from transitioning from climbing towards that faith zone.
Exactly. They get stuck in the dependent zone, and the gradient flattens further.
Okay, so the NFIB data, this is where the abstract model really hits the ground, right? It's the real-world validation.
It is.
The Small Business Optimism Index, reading 98.2 in this report, confirms this structural stress. What are the specific behavioral signals from that NFIB data that McLarty is using to prove the gradient is actively flattening right now?
Yeah, the report really hones in on three undeniable confirmations of this structural pressure playing out. First is the profit squeeze.
We mentioned that.
Right. Small firms are reporting shrinking profits. Why? Because they lack the pricing power of those big faith zone companies. This isn't just anecdotal, it's measurable proof that the gap in margin resilience is widening.
So, importantly, it's not necessarily about them mismanaging their business.
No, not at all.
It's about their structural inability to manage costs and pass them on the way a scaled system can.
Exactly right. It's structural. Second, they cite widespread inventory cutback.
Behavior again?
Key behavioral signal. This confirms that caution signal from the tri-engine, remember? Businesses are actively reducing inventory risk.
Why?
They're hesitant. Hesitant to commit capital forward because they fear demand uncertainty, they fear credit access volatility, they're hoarding liquidity, playing defense.
Okay, profit squeeze, inventory cuts. And the third point must directly confirm one of those drivers you mentioned.
Absolutely. The reported credit tightness, this is straight from the horse's mouth, so to speak. Small businesses are confirming, in the survey, difficulty in securing loans and facing rising loan costs.
Direct proof.
It's direct behavioral proof that the mechanism driving the flattening gradient that squeeze on available and affordable credit is actively and currently in play on Main Street. It's happening now.
Wow. The synthesis here is pretty compelling. The proprietary narrative they created for this Vault feed report, it sums it up perfectly. It says, the behavioral flow gradient is now visible in Main Street data. Faith is retreating from those who borrow, not those who build.
That's a powerful line.
It really cuts through. This isn't about being bearish just for the sake of it. It's about being, well, structural, seeing the underlying forces.
And that, quote, it perfectly translates the structural understanding into the strategic mandate for De-Investment Enterprise, LLC. That's the whole point, right? Synthesizing this NFIB data is all about confirming the validity of their own highly disciplined strategy, which is based on this fundamental structural understanding.
Okay, so how does this knowledge translate directly into their strategy? What does a firm like De-Investment Enterprise actually do when they confirm the existence of this widening structural chasm?
Well, they implement what they specifically term a faith reserve system.
Faith reserve system.
Yeah. The strategy basically avoids fighting these powerful structural forces. Instead, it aligns with the prevailing economic reality identified by the gradient, and it's built on three core pillars.
Okay, what are they?
1. Capital discipline. This means they focus pretty much exclusively on stable assets and those identified systems of faith.
So no speculating on turnaround stories in the dependent zone?
Generally, no. They want to capitalize on stability itself.
Makes sense. Pillar 2.
2. Liquidity preference. Prioritizing easily tradable, safe assets. Think T-bills again, large cap stocks. Things that can weather structural pressure and can be sold easily if needed.
Safety and flexibility. And 3.
3. Avoidance of credit-dependent exposure. They maintain extreme caution toward those firms of reliance, the ones highly vulnerable to that flattening credit gradient. They step away from that exposure.
So the data from struggling small businesses, in essence, validates the LLC's strategy of basically capitalizing on the institutional flight to stability.
You got it. They are translating observed market structure, confirmed by Main Street behavior, into sustainable yield by positioning themselves firmly within that faith zone.
They're harvesting the premium associated with concentrated faith.
That's a good way to put it. This is the mechanism. They aren't predicting, not in the traditional sense. They are positioning, using their proprietary models, validated by observed behavior, to thrive in an environment where these structural forces clearly favor scale over reliance.
So wrapping this up, what does this all mean for you, the listener, the learner? This deep dive, I think, really shows us how sophisticated market players are using behavioral data, real data, from Main Street small businesses to confirm a fundamental and apparently growing structural divide in the economy.
Yeah.
It's really not about emotional sentiment, is it? It's about the underlying structural pressure exerted by credit markets, by labor markets.
And the true power here, I think, is identifying that structure, separating it from just market noise. The fact that the NFIB data provides such direct behavioral confirmation for the tightening credit and labor effects, it gives this structural thesis tremendous weight.
It really does.
And it definitely raises an important question looking forward. If these structural forces continue to favor scale and stability, I mean, how far apart can the faith and dependent zones truly get before the strain on the broader financial system maybe becomes unsustainable? That's the big unknown.
A critical question. And to leave you with that structural insight designed to stick, we should return to that concluding aphorism from the McClarty report itself.
Ah, yes, the final line.
Gold measures fear. The DR measures faith. The dollar measures dependence.
It's a powerful encapsulation, isn't it? How conviction aligns with different asset classes, different anchors, really highlights the need for their kind of structural integrity computation.
Absolutely. And maybe a final thought for you to explore on your own. Take a moment and consider which assets in your own portfolio might fall into that system of faith category versus the firm of reliance category, based on their inherent need for cheap credit just to survive or thrive.
Understanding your own exposure to that flattening gradient.
That's the first step toward capital discipline, right?
Mhm.
Something to think about. Thank you for joining us for the deep dive.